In the Nigerian stock market, everyone wants to make money, but very few actually do. Some buy a stock at 20 naira, sell at 30 naira, and call it profit. Others hold for years, waiting for that next preschool moment. Most people are playing only one side of the game because in reality, there are four main ways people make money from the Nigerian stock market. And if you don't understand how each one works, you'll always be chasing luck instead of building real wealth. Hello, my colleagues, welcome back to the channel. And if you are new here, you are absolutely welcome too. In today's video, we are breaking down the four real ways investors make money from the Nigerian stock market, and more importantly, which one fits your own personality and goals. I'll also show you a simple framework that I personally use to filter quality stocks so you can stop guessing and start investing with confidence. Before we dive in, please hit the like button so this video reaches more Nigerians who want to invest smarter. Subscribe to the channel if you haven't already, and join my WhatsApp channel. That's where I share my latest research and what I'm watching in real time. Alright, without much talk, let's jump right into today's video. Let's go. Now, let's start with the one everyone thinks they understand: capital gains. Buy low, sell high. Sounds easy, right? But in real life, it's not that simple. The Nigerian market doesn't move in straight line. One CBN policy, one FX change, one oil shock, and the whole market flips. So how do people actually make money from price movement without getting burnt? The answer is simple: follow rules, not emotions. Rule number one: buy when everyone is scared or selling. That's usually when prices are low and no one is talking about stocks. For example, during the 2020 crash, Access Bank dropped to about 6 naira per share. Those who bought them and waited a few months saw it rise to about 9 naira. But most people didn't buy at 6. They rushed in later when everyone online was shouting access to the moon. That's how people actually get trapped in the market. Rule number two: buy based on facts and not hype. Before buying, check if the company is still strong, making profits, paying dividends, and managing their debt. If the company is healthy but the share price has crashed because people are afraid, that's your opportunity, guys. That's what investors mean when they say look for value first. Third, or rule number three: always have a plan. Don't just buy and hope. Decide before buying. Ask yourself, at what price will I sell if it goes up? At what point will I sell if it goes down? That way you are not making emotional decisions. For example, if you buy a stock at 100 naira, you could plan to sell it at 140 naira if things go well, and sell at 85 naira if things go bad. This way you know your limits and never panic when the market starts fluctuating. And rule number four is you want to be patient. This is not a 1 week game. Sometimes it takes months before the market rewards you. Real investors make money because they give their ideas time to work. Rule number five: think about the real value of your money. Making 50% profit means little if inflation, or let's say devaluation, eats it all. So always think in purchasing power. How much is my 4 million naira worth today compared to years ago? That mindset helps you build true wealth, not just big numbers on paper. Now let me give you a quick example. Let's say a strong bank share price crashes from 100 naira to about 60 naira because of a news or market fear. You check the company fundamentals, profits are still solid, there are no scandals, and they keep paying their dividend like they have been using. Then you decide to buy at 60 naira. When things calm down, the price will likely climb back to, let me say, 90 naira. That's a 50% gain, guys. You sell, take profit, and move on without stress. The bottom line here is that capital gains can make you real money, but only when you follow a rule and plan. Buy when others are fearful, focus on strong companies, set your targets, and like I've said, be patient. That's how smart Nigerian investors really make money from price movement. Now let's talk about something most people also overlook, which is dividends. Dividends are not bonuses. They are simply your share of the company's profits. When a business like Zenith or GTCO makes money, it shares part of that profits with shareholders, usually twice a year. That's called a dividend. It's the closest thing to cash flow you can get from stocks. You're literally getting paid while you wait. But here's the key: the real power isn't just collecting dividends, it's reinvesting them back. Each time you reinvest, you buy a little more of that company, and next time your dividend is slightly higher. Over time, that's how compounding quietly builds wealth for you. Let's make it practical. Imagine you invest 10 million naira in a strong dividend stock, say a bank that pays around 10% yearly. That's 1 million naira in dividends each year, right? If you spend it, it ends there. But if you invest that 1 million naira every year after 10 years without spending a single extra kobo, your holding could grow to roughly 24 million naira, assuming stable prices, and you keep on reinvesting that money. That's the quiet power of compounding. You didn't trade, you didn't chase trends, you just owned a good business and let the profits roll back into more shares. Now, let's clear up one popular myth, the dividend timing trick. Let me clear that myth for most of you guys. Some traders try to buy a stock just before dividends payment and sell after they have paid the dividends. It sounds smart, right? Except that it rarely works, and here's why. You see, once dividends are announced, the market already knows, and the day after the qualification date, the stock usually drops by roughly the same amount as the dividend paid. So if a company pays 2 naira per share in dividends, its price will likely fall by about 2 naira the next morning, meaning you didn't really make free money, you just moved value from one pocket to another. Real investors don't chase dividend dates, they buy businesses that consistently produce profits, pay dividends, and grow earnings over time. That's where true steady wealth comes from. Now, speaking of getting free money in terms of dividends, let's talk about one of the biggest illusions in the Nigerian stock market called bonus issue and stock split. You have probably seen those headlines: 1 for 5 bonus, company gives shareholders free shares, and immediately people get excited thinking they just got richer overnight. But here's the truth: bonus shares don't make you richer on the day they are issued. They only increase the number of shares you hold, not the actual value of your investment. Let's make it real. Say you own 5,000 shares of GTCO at 35 naira each. That's about 175,000 naira in total value. Let's say the company declares a 1 for 5 bonus, meaning for every 5 shares that you own, you get 1 extra new share. So you now have 6,000 shares, right? But the market now adjusts to reflect that increase in supply. Your new share price drops to roughly 29 naira 17 kobo. And guess what? That 29 naira 17 kobo times 6,000 naira is still going to give you 175,000 naira. So you are still holding the same 175,000 naira stock value. So now, if nothing changed in value, where's the money? It's in what the bonus represents, not in the bonus itself. You see, a bonus issue is not just a gift, it's a signal. It tells you two things: a company has built up huge retained earnings, meaning they have been profitable for years. Secondly, it tells you management believes the business can keep growing fast enough to support more shares in circulation. That's why bonus often comes from financially strong companies. Firms like VFD Group, Total Energies, Seplat, or GTCO. These are businesses with consistent profits and long-term expansion plans. So instead of chasing the free shares, smart investors read the message: this company is confident about its future. Now, here's how you can actually make money from it. Imagine you own 1,000 shares of a strong company at 100 naira each. That's 100,000 naira in value. Now, the company issues a 1 for 4 bonus, and you now have 1,250 shares. Immediately, the price adjusts to around 80 naira, keeping your value at 100,000 naira. But because this company is fundamentally solid and still growing profits, still paying dividends, its price begins to recover over time. Maybe after 12 to 18 months, like what happened to VFD Group, it's back at 100 naira per share. Now your 1,250 naira shares times 100 naira is now equal to 125,000 naira. You have just made 25,000 naira without trading or trying to time the market, just by holding through the bonus and letting the business compound for you. That's how real investors profit, not from the announcement, but from the recovery and growth that follows after a bonus issue. So the lesson here is simple: don't celebrate free shares, celebrate the financial strength that made them possible. When a company declares a bonus, your job is not to sell in excitement. Your job is to check if it's still a quality business. If it is, you want to hold, because when the price recovers, those extra shares will quietly multiply your wealth. It might not be overnight, but steadily over time. This is what separates traders from real investors. And speaking of compounding, let's go even deeper, because the real money in the Nigerian stock market isn't just in dividends or bonuses. It's in what happens when you own the right companies long enough to benefit from the big structural shifts they go through. I'm talking about corporate actions, things like mergers, acquisition, recapitalization, re-ratings, and even listing on new markets. These are the quiet moments that multiply wealth for patient investors. Let me explain. When you hold a strong business for years, you are not just collecting dividends, you are owning a company that's actively evolving. And when those changes happen, the market often reprices the company's value upward. Take GTCO for example. When it transitioned from a bank to a holdco structure, most people didn't realize how big that was. It meant that the company could now own and operate subsidiaries beyond banking, like fintech, asset management, and payments. New income lines that didn't exist start popping up. Investors who understood that shift and held on through the process saw the company's valuation re-rate as the market began to price in its its new growth potential. Or even look at Aradel Holdings. For years, it quietly built value as a private integrated energy company when its shares started trading on the NASD before it now went on to now list on the official NGX. Early investors saw the massive revaluation not because the company suddenly became better, but because the market finally caught up to its true value. That's how compounding really works. You are not just chasing price jumps or speculations. You are waiting for big structural events to unlock the real worth of your investment. Now, here's the insight most retail investors miss. Wealth in the stock market isn't made from price jumps. It's made from owning quality business before they are re-rated. Every major Nigerian success story, from Dangote Cement to Boa Foods to GTCO, has gone through these cycles of reinvention, listing and expansions, and every time they did, long-term shareholders got rewarded. So if you really want to make money from the market, stop trying to predict daily prices. Instead, focus on finding companies that are building something bigger than themselves. Businesses with strong balance sheets, reinvested profits, and clear expansion moves ahead. Because when that next re-rating comes, and it always does, guys, you won't need to trade every week. You just wake up one day and boom, the business that you quietly held has compounded into something much larger than you expected. Now, let's try to make this video more practical, because I know you'll be saying, Micah, how do I actually find this kind of early companies? The answer is simple. You want to use a framework, which is a few key metrics that professional investors rely on before buying any stock. The first is look at the return on equity, ROE. A strong company should have a ROE of above 20%. That basically tells you how efficiently the company uses shareholders' money to make profits. If a company earns 20 naira for every 100 naira invested, that's solid performance. High ROE means management is doing something right. Next, especially for banks, is to check their CIR, which is cost to income ratio. This shows operational efficiency and how much the company spends to earn every 1 naira. If a bank CIR is 50%, it's meaning it spends 50 kobo to make 1 naira. Lower is better because it actually means the company is running efficiently. For banks, also look at the non-performing loans. Low NPLs mean the bank is lending wisely. High NPLs, that's a red flag. It shows too many risky loans that may not be repaid. Then look at the price to book ratio. This compares the company's stock price to the company's net asset value. Remember, if a company has strong profits, good ROE, and the price to book ratio is less than 1, you might be looking at an undervalued gem. This is how investors spot good bargains. Finally, you want to check for consistent dividend growth and history. A company that steadily raises dividends shows confidence and stability. It's a signal that management is committed to rewarding shareholders over the long term, not just chasing hype. Now, don't worry if this feels like a lot. The key idea is simple. You are looking for efficiency, discipline, low risk, fair valuation, and consistent reward. If a company ticks those boxes, you are probably looking at a future winner. And the best part is you don't need to be a financial analyst to find these numbers. They are all available in the company's annual reports, usually under the profitability, efficiency, and valuation sections. And here's where it gets even better. We are currently building a tool called Affirmatrix, a platform that is designed to make this process 10 times easier. It will help you track your Nigerian stocks. You see all these metrics in one place and even spot opportunities most people will likely miss. If you want early access to this tool, you can join the waitlist. The link is in the description, and I promise you it will give you a serious edge in the market once it goes live. Like I said, you'll find the link to join the waitlist in the description and pinned comments. And remember, all of these dividends, bonus issue, corporate actions, and the framework we have just discussed, it all comes together with time and patience, because the real money in the Nigerian stock market isn't in chasing hype or quick gains. It's in owning quality businesses, understanding their fundamentals, and letting the compounding and structural growth work in your favor. If you found this breakdown helpful, hit the like button. It really helps the channel to reach more serious investors. Share this video with someone. And for my personal research notes and what I'm currently watching in the market, don't forget to join my WhatsApp channel. The link is in the description and pinned comment. Thank you so much for watching, and as always, stay safe, invest wisely, and deal.